Here are 5 brilliant hacks I use to help you quickly identify the most profitable fair value gaps. First, let's understand what fair value gap is. What is fair value gaps? Fair value gaps are chart imbalances identified by a 3-candlestick pattern. For a bullish fair value gap, the first candle's high doesn't overlap with the third candle's low, creating a visible gap that the market often retraces to fill, either partially or completely, before resuming the trend. The opposite is true for a bearish fair value gap, where the first candle's low doesn't overlap with the third candle's high, leaving an imbalance that attracts market movement. These gaps act like magnets for price action, providing a draw on liquidity that can be targeted when taking profits. You can also use them to enter trades after a valid setup forms. Number 1. When you see multiple fair value gaps in one setup, focus on the bigger ones. Larger gaps work better than smaller ones because they show a stronger imbalance between buyers and sellers. This makes them more likely to act as strong support or resistance levels. Number 2. If you come across a setup with multiple fair value gaps of similar size, and none stands out as significantly larger, the key is to prioritize based on their position. Typically, fair value gaps located in the lower portion of the move have a higher likelihood of success. To pinpoint this with precision, you can use a wonderful tool like the Fibonacci available on charting platforms such as TradingView. Adjust the tool's settings to include price levels at 0, 0.5, and 1. Then, drag it from the swing low to the swing high of the movement containing the gaps. The middle line will act as a divider, helping you focus on the fair value gaps in the bottom half while disregarding those in the top. For short trades, reverse the process. Drag the tool from the swing high to the swing low, and concentrate on the gaps in the upper portion. Number 3. We see candles here. The high of the first candle and the low of the third candle. This forms a fair value gap. To analyze it, we need to draw a line at the midpoint of the fair value gap. This midpoint is called consequent encroachment, CE. Let's learn how to use the fair value gap. CE helps us evaluate the strength of a fair value gap. If a candle touches the wick and closes above the body, we consider it a strong fair value gap. If the price breaks the wick and closes above the body, we can take a buy decision. If the market revisits this level, breaks through the CE, and closes below the body, we will treat it as a weak fair value gap. To find the middle line of the fair value gap, go to TradingView, open the settings, and turn on the middle line option. In an uptrend chart, we might see the fair value gap break through CE, but close above the body. This signals a buying opportunity. Here's another example. If the CE of a fair value gap breaks through the candle but closes above the body, this indicates the fair value gap has failed. Number 4. Let me show you how to make a proper entry by moving from a higher time frame to a lower one. First, we look at a 1-hour uptrend chart. We can see a clear fair value gap. We don't buy right away, but wait for the market to come back to this gap. Next, we check the 5-minute chart for confirmation. The 1-hour fair value gap is still visible, but now we wait for the 5-minute structure to break. Once it does, we draw a new fair value gap on the 5-minute chart. After this, we can confidently take a buy entry. Number 5. A fair value gap that forms when a structure breaks is called a golden zone. When the chart moves into an uptrend, it forms higher highs and higher lows. For example, in a bullish market, the previous high is broken, and a fair value gap appears. Wait for the pullback and take a buy position.